One of the more important aspects of evaluating Intel stock as an investment is the company's financial situation. The company's finances have been under pressure as it's invested tens of billions of dollars in latest research and development and manufacturing expansion. So in this video, I wanted to review the latest progress on the company's finances, what the future looks like over the next few quarters to the next few years, and what it could mean for Intel stock investors who are looking for the company to restart its dividend that it paused because of the pressures on its cash position. So let's take a look.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So Intel management understands that investors are not pleased with its results and are looking for improvements. And one of the things they're doing is a massive cost-cutting campaign. And as a part of that, they're going to take a $2.2 billion severance expense to lay off approximately 15% of their employees. The way these layoffs work is that the company usually absorbs higher costs upfront associated with those severance packages, and then they benefit from lower expenses in future quarters as they have less employees to pay, less employees on the salary. However, these are very expensive to implement. I've discussed this at great lengths in late 2022, early 2023. Remember when many of the large cap tech companies announced similar cost cutting plans, Microsoft, Alphabet, Meta Platforms, etc. They all implemented massive cost cutting plans and had to pay billions of dollars in severance. Intel now taking its share here, $2.2 billion in expense associated with this severance in laying off 15% of their workforce. Thankfully, operating cash flow in the third quarter was impressive, $4.1 billion, and incrementally that was up by $1.8 billion from the previous quarter as the company improved its working capital position. Now, they did spend an extra $6.5 billion on capital expenditure, which resulted in free cash flow of negative $2.7 billion. So still, the company's cash position is going backwards, not improving overall because they're still making those investments. They're not yet completed in paying for these investments. Now, they still have $24 billion of cash in short-term investments, and in the most recent quarter, they paid down almost $3 billion in debt. And so that's going to improve the cash position going forward because debt usually has interest expense associated with the debt. Sometimes you have zero coupon bonds where you're not paying interest expense on the debt, but you're accumulating interest expense and then you pay back the bonds at the end of the term. But sometimes you do have interest expense that you have to pay quarterly or biannually out of pocket cash expense. And so this will alleviate some of those concerns. And as the company generates more cash, they remain focused on decreasing their debt next year as their cash from operations continues to improve. So that's going to be a tailwind for Intel, their financial position to improve as they use some of this cash to pay down the debt, which will then lower the interest expense, which will then create more cash to pay down more debt, etc. And they can do this for some time because their debt balance increased to unreasonable levels and they do not want to have debt as high as it is, and they'll work to pay that down. In another good sign, the company's data center AI segment revenue increased 10% from the previous quarter as demand for traditional servers improved. So that's going to be good for their financial position that traditional servers are sequentially improving. Remember, the big investment trend right now is artificial intelligence, and the newer data centers optimized for artificial intelligence, Intel is losing market share to that category. Traditional servers are being updated to servers optimized for AI. So it was good to see that the company still generated some revenue and incremental increase in revenue from this traditional service segment, this legacy segment, this segment that they can see how much cash they can squeeze out of this segment before it's completely transitioned into these data centers optimized with AI. Now, the biggest cash outlay for the company is the Foundry segment. And the Foundry segment operating loss came in at $5.8 billion, and that was down from the previous quarter. And that was driven by $3 billion in impairment charges, which is a non-cash expense. And they expect these losses to continue at the same rate in the next quarter, but minus that impairment charge. So if you look at the operating loss of 5.8 billion, that included the 3 billion. That means the forecast they're sharing with you here is that they're going to experience a loss of around 2.8 billion in the upcoming quarter. But they expect these operating losses to improve significantly. And that's great news for Intel stock investors, because this is the segment that the company is experiencing the biggest headwinds on, is the Foundry segment. This is what's absorbing a lot of the capital expenditure and a lot of the losses. However, that being said, they expect this segment to drive huge increases in revenue and profit and cash flow starting in late 2025 and early 2026 as these manufacturing facilities get stood up and start ramping and increasing the number of units produced, and they can in-house some of the manufacturing that they are outsourcing. They can bring it back in-house and have greater capacity utilization of these facilities, and thereby drive huge improvements in profitability, which is what the company is forecasting and is expecting. They go on to say that they're forecasting $13.8 billion at the midpoint in revenue, with gross profit margins close to 40%. And they're sizing up the business to support trendline revenue growth of 4% at the midpoint annually, with optionality to scale up to 8% revenue growth if demand improves. Furthermore, their gross and net capital investments will be approximately 25 billion and 11 billion respectively in 2025. So they're going to spend $25 billion on capital expenditure. However, the net impact is going to be $11 billion. And I'm sorry, this is for 2024, not 2025. And the reason why the net is going to be significantly lower than the gross is because the company is getting back billions of dollars from the US government for these capital expenditures. So they are getting subsidies, and they have partners for some of the other manufacturing facilities where they're getting billions of dollars to fund these expansion facilities and share some of the capital expenditure of those facilities by co-investors in those facilities. So really important stuff here for Intel stock investors to consider if you're interested in Intel stock, being one of the larger semiconductor companies in the United States. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.